Sam, we tend to see some of these moves more exaggerated on light trading days. How much of this is really just profit taking at the end of the year?
Hey, Kiko. Well, yeah, I think that traders are like surfers, and if they don't have any waves, they'll try to make them. And I think that's what they're doing today, really trying to hit some sell stops or whatever to just increase the activity. I think that with the market just being pretty lightly attended today, investors really shouldn't worry too much about it. But at the same time, because we did get that surprise sell-off following the Fed meeting, I think some investors probably did accelerate when they're taking their profits. So doing it a little bit this year rather than waiting until next year.
Sam, remind us why investors should pay attention to the Santa Claus rally, Sam, the last 5 sessions of this year, the first 2 of the new year.
Hey, Josh. Well, it was something that I read about in the Stock Traders Almanac, that essentially the last 5 trading days of the calendar year plus the first 2 trading days of the new year, if that period is positive, then it indicates a positive full year for 2025. It would be correct 74% of the time, rising about 10.5%, about 1 percentage point more than the market did every year, and slightly better on a batting average basis. But if the Santa Claus rally does not appear, meaning we have a negative return in that 5 or 7 day trading period, the market still was up almost 6%. Yet it was higher only 1 out of every 3 times. So not a great indicator. I prefer actually the January barometer. As goes January, so goes the year.
Sam, it's interesting to say not a good indicator. That was my follow-up there. How much of these correlations we've seen historically, traditionally, can be applied going into 2025, given a lot of the unknowns that could come from this new administration?
Sure. Well, that's why I like the January barometer, because it basically encapsulates what investors are thinking in the first month of the year. And if they're willing to put some money to work early on, then they have evaluated what the longer term prospects are likely to be. And in the first year of a president's term in office, going back to World War II, if the market was up in January, it was higher 91% of all of those years, with an average gain being in excess of 18%. If the market was down in January in the first year of an election, first year of a term in office, then the market was lower by about 2%, and again, only advanced 1 in 3 times.
Sam, I want to talk about the 10-year with you as well. We had a technician on the show this week. Sam said that is the single most important chart he's watching right now. We've backed up to 462 here, Sam. How much of a challenge does that pose to the stock market?
Well, I think psychologically it poses a problem. I mean, when you go back to 1953, when the Fed started to share with us 2-year or 10-year Treasury yields, the average is about 5.5%, 5.75%. So that's it's a full percentage point higher than where we are right now. So I think investors were a bit spooked by the inflationary readings of the past month, and I think they'll probably get spooked even more so because the readings that we will get for December in January are probably going to be a little hotter than the prior month. So I would tend to say that as the year progresses, the inflation data will probably get a little bit better, but we still have a rough road ahead of us.
Sam, it is always good to see you and have you on the show. Happy New Year, my friend.
Thanks. Happy New Year.